Picture this. You enter a trade. The setup is just flawless.
Oh yeah, the perfect setup.
Right. The chart is moving exactly in your direction, and for a few glorious minutes, you feel like an absolute genius, like you finally cracked the code.
You're already mentally spending the profits.
Exactly. But then a tiny pullback happens. Not a market crash, not some catastrophic news event, just a completely normal, like everyday market fluctuation.
Just a single red candle.
Yes, a single red candle. Yet your heart starts racing, your palms actually get sweaty, you stare at the screen, a knot forms in your stomach, and the only thought in your head is, I have to save this small profit before it vanishes completely.
Survival mode just totally kicks in.
So you panic, you close the trade, and you lock in a few meager bucks, you breathe this huge sigh of relief, and then you sit back and watch as, I don't know, 5 minutes later, the market rockets straight to your exact original target.
It is just brutal. It really is.
You're left staring at the empty wall, asking yourself that echoing question, why did I just do that?
I mean, it's one of the most painful experiences you can have sitting at a computer, yet it happens millions of times a day.
Welcome to today's deep dive. Today, we're unpacking a massive debate in the financial world. And it's really about that exact feeling.
Yeah, because it gets right to the heart of a battle that has absolutely nothing to do with finance, actually. It's entirely about human psychology.
Which is so interesting, because I talk to frustrated, everyday traders constantly, and the prevailing belief is always rooted in the idea of just needing more. Like if I just learn a more advanced strategy.
Right, a better algorithm or something.
Yeah. Or if I pay for a better indicator or spend an extra 4 hours a day staring at candlestick patterns, I'll finally win. I just need a better system.
That is the universal assumption, you know? But the research points in a completely different direction. The core argument from the trading psychology side is that your strategy, I mean, no matter how brilliant or back-tested it is entirely useless if your emotions hijack the controls.
The second real money is on the line, right?
Exactly. You could have the most sophisticated tactical plan in the world, but if your nervous system triggers a fight or flight response when the pressure hits, that plan just goes right out the window.
We should probably set a quick ground rule before we dive into the mechanics of this, actually.
Yeah.
We are avoiding dense financial jargon today.
No complex math.
Right, no confusing acronyms. We're looking strictly at human behavior. We're going to figure out why incredibly smart, rational people self-destruct when money's on the table. And more importantly, how you can stop it.
Which is the part everyone wants to know.
So to do that, we really have to start at the root. What is it that beginners fundamentally misunderstand about the act of losing money?
Well, the biggest misconception is that traders lose because they're ignorant of the market. People assume losing traders just don't know how to read a chart.
But that's not true.
Not at all. The reality is quite the opposite. Many struggling traders actually possess fantastic analytical skills. Like, they can identify highly probable, really decent setups.
So the analysis isn't the problem.
Right. The short circuit doesn't happen in the analysis. It happens when real money enters the chat. The game fundamentally changes from this logical, low-stakes puzzle into a high-pressure survival scenario.
Because the stakes are real now?
Yeah, and it activates two forces that human beings desperately biologically care about. Money and the ego's need to be right.
So the moment you click buy, you aren't just watching red and green numbers tick up and down on a screen anymore.
No, you are watching a real-time ledger of your self-worth. You're watching your confidence, your hopes for the future, your deep-seated fears. All of it fluctuate tick by tick.
Wow.
A winning trade doesn't just make you richer, it makes you feel inherently superior and intelligent. And a losing trade doesn't just cost you $50, it feels like a personal indictment of your intelligence. It feels like an attack.
Okay, I have to challenge that a little bit, taking the side of the everyday trader here. Because when you're in a trade and the price suddenly whipsaws aggressively against you.
It's like it triggers your stop loss by a single penny before reversing and going to the moon. I mean, it really does feel personal. It feels incredibly deliberate.
It totally does.
It feels like the market algorithms are actively hunting retail traders, looking for where we hid our stop losses. You sit there thinking the market is actively out to get me.
That feeling is incredibly visceral, but it's actually the core illusion that ruins accounts. The hard truth is that the market does not know you exist.
It doesn't care.
Exactly. It's a completely neutral, massive ocean of global liquidity. It's neither your friend nor your enemy. It's just a mechanism moving based on millions of collective buying and selling decisions worldwide.
It's essentially a giant, unfeeling weather system. I mean, it doesn't rain just because you forgot an umbrella.
That is a perfect way to view it, but our brains aren't wired to accept that kind of neutrality. We are storytelling creatures.
We need a narrative. Right. Our emotions force us to project a deeply personal narrative onto completely random, neutral data. When the price drops, your brain invents a villain. Like, the market is trying to steal my money.
And when it goes up,
When it goes up, your brain invents a hero. I knew it. I'm a trading god who can predict the future. Both of those narratives are complete departures from reality. And if you're trading based on a fictional story your ego invented, you're going to lose your capital.
okay, so if the problem is emotional and not tactical, let's look at the specific emotions that actively destroy profitable trades while they are happening in real time.
The two big ones.
Yeah, the two distinct faces of ruin here, fear and greed. Let's start with fear because this is where the psychology gets really fascinating. The source material highlights that fear actually does the most damage when a trade is winning, which sounds completely backward.
It violates common sense for sure. You'd naturally assume fear only surfaces when you're watching your account bleed red. But fear is incredibly potent when you are in profit. You enter the market, the trade goes in your direction, and instead of calmly letting your statistical edge play out, this deep panic sets in.
You just want to grab the money.
Exactly. The thought process isn't about winning anymore. It's about not losing what you've just gained. You think, I need to secure this small profit right now before the market takes it back.
But the old Wall Street adage is, nobody ever went broke taking a profit. Securing a win feels like a responsible conservative decision, doesn't it?
Well, taking a profit according to a predefined mathematical plan is responsible. Taking a premature profit just because you're experiencing a spike in cortisol, that ruins the fundamental math that keeps traders afloat.
How so?
We have to look at the risk-to-reward ratio. Let's say your personal strategy dictates that you're willing to risk losing $100 to potentially make $300. You're aiming for a 3-to-1 reward.
Okay.
If you follow that math, you can actually lose a majority of your trades and still be highly profitable over a year. The math protects you.
But the math only protects you if you actually let the winner hit that 300 mark.
Exactly the issue.
Right.
If every single time that trade hits $60 or $80 in profit, your fear center lights up and forces you to hit the close button, your entire mathematical edge is destroyed.
You're still technically stringing together winning trades, I guess.
Yeah, but the wins are microscopic.
So if fear cuts every single winner short, you're changing the math in real time. Now, just one normal, mathematically planned loss of $100 is going to completely erase 3 or 4 of those tiny, panicked wins.
You bleed your account dry by 1,000 tiny cuts, and all while proudly telling yourself you're a winning trader.
Wow.
You're winning the battle for dopamine, but losing the war for your account balance.
It's so counterintuitive. It's like planting a fruit tree in your backyard. You do all the hard work. You dig the hole, you plant the sapling, you water it diligently for weeks.
Yeah, you put in the effort.
And finally, you walk out one morning and see the very first tiny little green fruit sprouting on a branch. And instead of letting it ripen and grow into a full harvest, you get so terrified that a bird might come along and peck at it, or a neighbor might steal it.
That you just chop it down.
Right, you take a chainsaw and chop the entire tree down just to secure that one tiny, unripe fruit.
That is exactly it. You secured the asset, but you completely killed the potential. You never allowed the system to actually do what you built it to do. You traded long-term exponential growth for short-term emotional relief.
That is the insidious nature of fear, chopping the tree down early just to feel safe. So let's flip the coin to the other extreme, greed. If fear closes good trades too early, greed keeps them open way too long.
Greed is that voice in your head that whispers, just a little more. Your trade executes perfectly. The chart hits your predetermined target of $300. Mathematically, you should be taking your profit and closing the platform.
But you don't.
No, you sit there, the dopamine is rushing. You look at how fast the candle is moving and think, this is a massive breakout. This could go to 500. I'd be a fool to close it now.
So you cancel your exit order.
You cancel it. And then the inevitable happens. The market breathes. The price pulls back.
And when it pulls back, the trader just closes it for a slightly smaller profit, right?
Yeah.
Like $250.
Rarely. Because now a new psychological bias takes over. Loss aversion. Your profit shrinks from 300 to 200. Even though you are still up $200, your brain perceives that missing $100 as a devastating personal loss.
Oh, wow.
Yeah, you feel like that money belongs to you and the market stole it, so you stubbornly refuse to close the trade, angrily waiting for it to go back up to where it was.
You're literally holding out for an apology from the market.
You are demanding a refund, and while you wait, a trade that was a massive, flawless winner slowly bleeds into a break-even trade. And because you're furious by this point, you hold it even longer, convinced it has to turn around.
And then it goes negative.
Exactly. That break-even trade turns into a red, painful, losing trade. Greed doesn't just reduce profits, it actively turns winners into losers.
I have to play devil's advocate here because this directly contradicts a lot of common advice. If you read any trading book, the golden rule is always cut your losers short and let your winners run.
Right.
If my trade hits the target and I decide to let it ride to see how much farther it can go, isn't that just me showing confidence in my own analysis?
That is the trap. Greed brilliantly disguises itself as confidence. It wears the mask of letting winners run. But we have to differentiate between a strategic decision and an emotional impulse.
Okay, how do you tell the difference?
Letting winners run is incredibly powerful when it is designed into the plan before the trade starts. If your strategy involves scaling out of a position gradually or using a trailing stop loss to capture a massive trend, that's strategy.
Right.
But if you had a firm, predefined target, the price reached it, and you suddenly threw the plan out the window just because your pulse was up and you felt greedy, that is not confidence, that's an emotional hijack.
So planned holding is strategy. Deciding you want more in the heat of the moment just because the green numbers look exciting is greed.
Greed fundamentally says, the rules don't apply to me right now, and it will empty your account just as fast as fear.
Okay, so we established that fear and greed are the monsters hiding under the bed when you're actively inside a trade. But what happens when the trade is over? Or, like, what happens on a Tuesday morning when the market is just moving sideways?
Yeah.
That brings us to the danger of boredom and pain. This is where impatience and revenge step in.
Impatience is a massive hurdle. There's a pervasive myth heavily pushed by pop culture that trading is about constant, relentless action.
Oh yeah, we all have that Wall Street movie image in our heads.
Yeah.
Shouting into phones, nonstop button clicking, sweat on the brow, making a million decisions a minute.
That Hollywood image is poison for a retail trader. When new traders sit down at their desk, watch the market for 5 minutes, and see that absolutely nothing aligns with their strategy, they feel incredibly bored.
They feel like they aren't doing anything.
Right. They have this toxic internal monologue that says, if I'm not clicking buttons, I'm not working, I'm wasting my time. So to cure the boredom and get that dopamine hit, they invent a trade that isn't really there. They force a terrible entry just to feel involved in the market.
It's like going out to the lake to fish. You spend all this money on gear, you row your boat out to the very middle of the lake, you drop your line in the water, and 5 minutes go by without a single bite.
And you just lose it.
Instead of sitting back, enjoying the quiet, and trusting the process, you get furious. You stand up in the boat and violently start hurling a massive net in every random direction, just desperately hoping a fish jumps into it by some miracle.
It really highlights the absolute absurdity of overtrading. Good trading professional, long-term profitable trading is mostly waiting.
Just waiting.
Yeah, you are waiting for the exact right setup. You're waiting for the market to come to your highly specific level. Many of the most successful traders in the world spend vastly more time doing absolutely nothing than they do executing trades. Often, the single most profitable decision you can make on a given day is to physically take your hands off the keyboard and walk away.
So boredom leads to forced trades. But what about pain? Let's talk about revenge trading. The phrase itself just sounds dark.
It is a very dark, very dangerous psychological spiral. Revenge trading almost always happens immediately after a painful loss.
Okay.
A trader takes a hit, their stop loss gets triggered, and they lose money. Instead of accepting that loss as a normal mathematical business expense like a restaurant paying for napkins, they take it as a personal insult.
The ego kicks in again.
The amygdala, the emotional center of the brain, completely takes over. Blood literally leaves the prefrontal cortex, the logical part of the brain. They immediately open a brand new, highly leveraged trade, often with zero actual strategy behind it, simply to win the money back from the market.
Let's break down why this is so toxic in real life. It's like playing a game of chess with a friend, and they beat you fair and square. You made a bad move, they capitalized on it. Instead of shaking hands, analyzing the board, and learning from the mistake, you flip the board over and demand an immediate aggressive rematch just to prove you are the smarter person.
That analogy hits the nail on the head, because in the moment of that chaotic rematch, you aren't playing chess strategically anymore, you're playing emotionally. When a trader revenge trades, they are no longer trying to make a good financial decision.
What are they doing then?
They're trying to repair a bruised ego. They want immediate relief from the psychological pain of feeling like a loser.
They're using your trading account to pay for emotional therapy.
And the financial markets are a very, very expensive place to try and fix your self-esteem. The market will never apologize to you.
So we've identified the enemies. We know fear chops the tree down early, greed refuses to cash in, boredom forces terrible entries, and revenge tries to violently repair a bruised ego.
We know exactly how these emotions disguise themselves as rational thoughts.
Right. But how do you actually fight back in real time? How do you win the inner debate when the pressure is on? Let's equip you with some practical, immediate solutions.
To solve it, we first have to recognize what that inner debate actually sounds like when you're in the thick of it.
Let's use a standard setup.
Yeah.
You enter a trade. You're risking $100, aiming for $250. The trade moves in your favor. You're up 120 bucks.
Feeling good.
Feeling great. But suddenly, a massive red candle prints on the chart. In an instant, your brain turns into a chaotic debate stage. Fear grabs the microphone and screams, "Close it right now. Secure the 120 before we lose everything."
And then greed steps in.
Yeah, greed shoves fear out of the way and yells, "No, this is just a pullback. Move the target higher. It's going to the moon." Meanwhile, impatience is pacing in the background, screaming, "I don't care. Just click something so I can feel something."
Exactly.
And discipline is just sitting quietly in the corner whispering, "Follow the plan." How does discipline actually win that shouting match?
Well, discipline cannot win a shouting match in the heat of the moment, because emotion is always louder than logic. Discipline only wins through advanced preparation.
Okay, so what's the first step?
The first practical rule is pre-planning. You must make all of your critical decisions before the emotional cocktail floods your brain. The moment you are inside an active trade, your functional IQ essentially drops.
That makes sense.
So before your finger ever clicks buy or sell, you must have 3 non-negotiable data points locked in. Exactly where you're entering, exactly where you will exit if the thesis is wrong, and exactly where you will take profit if the thesis is right.
So no improvising.
None. If you leave any of those 3 variables undecided, hoping you'll just figure it out as the chart moves, fear and greed will make the final choice for you.
Plan the trade in a state of logic, and then trade the plan to protect yourself from your own emotions. Okay, what if the plan is set, but the physical panic still sets in anyway? There's a brilliant, completely screen-free metric to diagnose this in the sources, and it comes down to position sizing. The rule is simple. If your heart is racing over a normal minor market pullback, your position size is simply too big.
Your physiology is the most honest indicator you possess. Many traders beat themselves up, thinking they have a massive psychological defect or that they lack mental toughness.
But they don't.
In reality, they just have a sizing problem. If one single trade makes you physically sweat, if your chest is tight, if it feels like your ability to pay rent depends on the next candlestick, you are risking vastly too much capital.
Because the stakes are too high for your brain to handle calmly.
Exactly. When the position size is too large, a normal market fluctuation feels like a mortal threat to your nervous system. A small profit feels like a winning lottery ticket you have to cash instantly.
So what's the fix?
The solution isn't more mental toughness. The solution is to shrink the dollar amount until you can watch the trade unfold with a calm, resting heartbeat.
It's a purely physical check. Pulse goes up, size goes down. It's that simple. Let's move to the third practical tool, emotional journaling. Every trading course tells you to keep a spreadsheet of your entries, exits, and profit and loss. But the real edge comes from tracking something entirely different.
Because numbers only tell you what happened. You need to know why it happened. You need to write down what you physically and mentally felt during the life cycle of the trade.
Like writing down your feelings.
Yeah, write down, I felt massive FOMO on this entry because I missed the morning rally. Or I closed this 20 minutes early because I felt pure fear. Or I canceled my profit target because I got greedy.
Why is making a diary of your feelings so crucial to a financial strategy, though?
Because it exposes the invisible patterns that are actually draining your account.
Yeah.
You might be sitting there for months thinking, my strategy is total garbage, I need to buy a new algorithm.
But it's not the strategy.
Right. When you look at your emotional journal, a shocking truth might emerge. Your strategy actually works beautifully. The losses are only accumulating because you constantly break your own rules out of fear or revenge.
You realize you don't have a strategy problem, you have an obedience problem.
Yes, and fixing indiscipline requires a completely different approach than, tweaking a moving average on a chart.
Which leads us perfectly to the ultimate psychological tool.
Yeah.
It doesn't cost any money, it's not a software subscription, and it's not a secret chart pattern. It is simply the power of the pause.
The pause is everything. Between the stimulus like a fast-moving chart or a sudden drop and your response, there is a tiny window of time.
A split second.
Yeah. The tool is simply taking one deep, deliberate breath before you click the mouse. In the space of that one breath, you ask yourself a single, clarifying question. Am I making a strategic decision right now, or am I just reacting to an emotion?
Am I executing the plan I made an hour ago when I was calm, or am I reacting to the fact that my stomach just dropped?
That 1 second of self-awareness can literally be the difference between a profitable year and a blown account. It interrupts the amygdala hijack just long enough for your logical brain to step back into the driver's seat.
As we bring this deep dive to a close, let's run through a rapid-fire checklist. The next time you sit down at your desk to trade, run through these 3 questions before you touch the keyboard. Number 1, do I have a clear entry, a hard stop loss, and a firm profit target planned right now?
Crucial.
Number 2, is my position size small enough that my heart rate is completely calm? And number 3, am I trading a legitimate high probability setup, or am I just trading my own boredom, greed, or need for revenge?
If we synthesize everything we've explored today, the core message is this: your emotions are not the enemy.
Right, you can't just turn them off.
There's this pervasive, destructive myth that to be a successful trader, you have to transform into an ice-cold, emotionless machine that is biologically impossible. You are a human being.
You're going to feel things.
You're going to feel the fear of losing. You're going to feel the dopamine rush of greed. You're going to feel the sting of a loss. The objective isn't to magically stop feeling those things. The objective is simply to stop letting those emotions have the final say over your mouse clicks.
You can sit there and feel the fear. You just can't let the fear execute the trade. You observe the feeling, but you execute the plan.
Acknowledge the emotion, respect it, and then look at your pre-written rules.
We started today talking about that flawless setup.
Yeah.
The trade that you panic closed for a tiny win, only to watch it hit the massive target without you. We spend thousands of hours trying to learn how to read the market's charts. We stare at complex indicators, trying to decipher the chaos and predict the future of global finance.
We really do.
But if algorithmic trading bots are specifically programmed to exploit human fear and greed, then every time you panic sell or revenge trade, you aren't just making a mistake.
Yeah.
You are doing exactly what the code was built to make you do. Next time you feel your pulse rise and your finger hovering over the panic button, ask yourself, are you trading the market, or is the market trading you?
The most important chart you will ever learn to read is the one mapping out your own mind. It is the only variable you actually have control over.
Think about that the next time you feel the urge to force a trade. Thanks for going on this deep dive with us, and we'll catch you on the next one.